So today, we continue or go even further, I guess one might say, into depth about independence in two respects. One, we have a continuation of our Wilmarth's presentation on independence from the banking industry. And then we have Sarah Binder from the Department of Political Sciences when we talk about independence from the political processes. So Art is going to start us off with about 25 minutes, probably 15 to 20 with presentation, and then keep it open for another 5 minutes or so for question and answer, and then we'll turn it over to Sarah and go to the political background. So, Art?
Okay, great. Tim, thank you very much. Nice to be with you again. So last time I focused mainly on discussing why the Fed appeared to be subject to significant influence from the financial services sector, in large part because of obviously direct representation of large financial services companies and many of their corporate clients on the reserve regional bank boards. And so there was a structural, strong connection between the private sector and the Fed. Certainly, there are many other cultural factors. I mean, the Fed obviously being the most preeminent and most prestigious of the federal financial regulators certainly has many interactions on a cultural basis with financial leaders at places like Davos, at Jackson Hole every year. The Federal Reserve of Kansas City puts on a big conference where all the board members come and all the industry leaders come. Davos, as many of you know, is where the international financial regulators and international financial leaders meet every January. Many other similar locales such as that. Also, the Fed maintains resident teams of examiners at the largest banks. And so there's a continuous presence of regulators at the banks, and there's a continuous interaction between bank regulators and financial executives. And as I said, as I think I may have said, much of the supervision and compliance process, at least leading up to the boom, was done through this, quote, examination process, which was highly confidential, not open to public view, not open to public scrutiny, protected from discovery under the Freedom of Information Act, very difficult to get discovery even in litigation. And the regulators would particularly, when they were criticized for not doing more public enforcement actions, that would repeatedly say, oh, don't worry, we're doing this through the compliance process, through the confidential examination process. We're taking care of it. We don't need to use public enforcement because we can nudge people and persuade people to do what they need to do through the examination process. But of course, that was all shielded from public view. There were no public advocates, no public ombuds people, no advocates giving perhaps a half cheer for the lawyers. There were no outside lawyers present, so that there was no way for the public to really know what was actually happening, through this very confidential examination process. I was interested to see that, having attended a couple of the chairman's lectures, that the one area where he actually acknowledged that the Fed had made a serious mistake during the boom, the run-up to the crisis, was the failure of consumer protection. And since otherwise he I think pretty much defended what the Fed had done, I thought that was an interesting acknowledgement on his part. Certainly the articles that I distributed to you and the excerpts of the article that I wrote that I sent to you, I mean, it's clear that the Fed got tremendous criticism for not having done enough to protect consumers and prevent predatory and excessively risky lending, during the run-up to the crisis. I actually think monetary policy did have a role to play as well. As I said to Tim, that's kind of another topic for another day. That would take sort of an independent 20 or 25 minutes to talk about monetary policy and the mistakes I think the Fed made, not just during the 2000s, but during the 1990s as well, that there was a long pattern of monetary policy and what I would call financial stabilization behavior, which conditioned the markets to think that they had an unlimited upside and the Fed would always come in to establish a floor if things got bad, if there was a crisis. And so you had what became an asymmetric risk curve, unlimited upside, but the Fed would come in and protect you on the downside. And I think that caused financial market participants to take more and more and more risks because they thought that those risks could pay off. But I wanted to spend some time today talking about regulatory failures. There was a very serious financial crisis in the 1980s and early 1990s. It was sort of a series of rolling regional real estate crises, some dealing with housing, many dealing with commercial real estate, but certainly anyone who lived through that crisis, as I did and observed it, would have immediately seen the warning signs of what was happening in the early 2000s. So the people who said we couldn't see it, no one could see it, no one believed that housing markets would ever go down in price on a nationwide basis. I mean, anyone who had lived through during the 80s and had watched it could see the same warning signs of overbuilding, overexuberance, too rapid price increases, too risky lending. All the signs were there. Now, one reason I think that the 1980s was a series of regional progressive crises and the 2000s was a single national crisis was that the banking industry changed in many ways due to the efforts of the Fed and their fellow regulators, because they broke down all the barriers to geographic expansion. They encouraged the consolidation of the industry into very large nationwide players and very large institutions. And the same thing happened in the securities industry. You had 5 giant securities firms leading up to the crisis, and you had about 8 or 10 really large banks and 5 really big ones leading up to the crisis. And so what had been sort of regional players became nationwide players. And so the excesses and the excessive risks occurred on a nationwide basis, all in coordinated time. So when the crisis came, it wasn't a series of regional crises, it was one big national crisis. And of course, it was a global crisis because, as I've said in some of the articles I've written, there were really 18 big financial conglomerates that were of worldwide importance. 10 of them were here, 8 of them were abroad, there were others as well, but those 18 really drove the financial markets, and they all engaged in the same kind of lending, securitization, the so-called originate to distribute, originate really risky loans, package them up into securities, sell the securities out to investors around the world, and hope that somebody else would be holding the bag or holding the hot potato when things went bad. That by this time, the originators and the securitizers would have gotten rid of all the risk. Of course, we know that in many respects they did not. They held on either directly or indirectly to many of the risks. But the illusion was, if you originate and distribute, you could originate really risky stuff, pay very liberally to the credit ratings agencies to get them to put AAA ratings on it, get it sold out to investors, and then presumably you wouldn't be suffering when all these investments began to blow up. Of course, that's not how it worked out, and that's, again, another topic for another day. What about regulation? So coming out of the crisis of the 80s and early 90s, it was clear that there had been inadequate real estate safety and soundness regulation. And Congress said at the end of 1991, in a statute that tried to put draw a line under that crisis, we want the regulators to adopt strong, uniform regulations, to prevent any recurrence of this unsafe and unsound lending. When the regulators got together at the end of 1992, a year later, they came out with guidelines. Okay, they didn't adopt binding, enforceable, strict regulations. They adopted a bunch of guidelines. And the guidelines, particularly in residential lending, were very weak. Now, the FDIC, to its credit, tried to push for strong regulations and strong standards. And the Fed and the OCC and the OTS basically pushed back and said, no, this will cut off credit, we need credit. And it's true, there was much like today, there was a credit crunch at the time. Banks were badly damaged and didn't want to lend. And the idea was, how do we get the banks to lend again and provide credit? And so the Fed and the other federal regulators won out over the FDIC and said, no, it's more important to have more credit. We need flexibility. The market will figure it out. The market has learned from this event. They won't be that risky next time, and so on. And this pattern repeated itself all through the 90s and into the 2000s. Every time there were repeated warnings, as more evidence and more evidence of predatory lending emerged, unsound subprime lending, unsound so-called Alt-A, option ARM lending, which was basically the so-called liar's loans. You know, no doc, no job, no income, no verification, but hand them a loan as long as they have a pulse. And all these loans were based on so-called teaser rates. So you got very low interest rates for the first year, 2 years, or 3 years, and then suddenly the loan would spike upwards after 2 or 3 years. But the banks and the lenders whom they financed, because in many cases the banks were providing funding to non-bank lenders to originate loans and sell them to the banks and then have them packaged up. Most of these loans were not being underwritten at the higher rate that would kick in after 2 or 3 years. They were all being underwritten at the teaser rate. I remember going to a meeting one time in 2004, which was about this problem of unsound subprime lending, and hearing someone say, well, you don't understand. If we had to underwrite at the fully amortized, kick-in rate when the rates go up, we couldn't provide loans to any of these people. And I thought, oh my God! I mean, the regulators have to know that they're underwriting at the teaser rate. This is a classic Ponzi scheme. If you can't keep rolling over those loans, they're all going to blow up. And that's what happened for a while. They were rolled over. Every time the teaser rate period would run out, either the lender who made the original loan or a replacement lender would come in and refinance it at a similar teaser rate loan. And of course, they had desire to do so because every time they sold the loan to be packaged up into securities, they got a fee. And they got fees from the borrower. The borrower would have to pay new fees to refinance. And in fact, most of these loans had what were called prepayment penalties. So if you rolled over your loan into a new one, you paid prepayment penalties on the way out, and you paid new financing fees and charges on the way in. So your equity was being stripped, both ways. The banks were collecting both ways, but the borrower could keep the game going. And so as long as housing prices went up, the refinancing option was there, or you could sell if you had to. But most people refinanced, and some people refinanced, 4, 5, 6, 7 times between the late '90s and 2007. Of course, what happened with housing prices is that you basically have a slow, gradual. You had a big dip after the 1990, during the crisis. Then you have a slow, gradual climb, and then once you get past 2000, as the bad credit accelerated, you have housing prices literally going up like this until essentially the end of '05. Then you have a slight leveling off in '06, and then suddenly in '07 they start going like that. Well, of course, what happened was you had refinancing done all the way up, the boom. But as soon as housing prices stopped rising and started falling, the refinancing option disappeared. Nobody was going to refinance one of these high-risk loans in a falling market. And as soon as the refinancing options disappeared, then the defaults multiplied. And as soon as the defaults multiplied and the foreclosures multiplied, then the housing prices started, tanking. And so you have this enormous, actually, this is a little bit over-dramatized. The housing price falls were sort of like this. So they went up by about 100%. They about doubled. We've come down off that doubling about 35% to this date. And we're still not, the housing market has still not recovered. And during this time, repeated warnings by lots of people, studies, consumer advocates, and at least the regulators privately were expressing concern. And the regulators would try to get together and do something. But they never came out with binding regs saying, stop this. This is no good. They would come out with guidelines repeatedly, several times, saying, well, you should be prudent. You should make sure that your borrower can repay the loan. You should make sure that the borrower can repay after the teaser rate period expires. You should, you should, you should. But there was nothing saying you have to. If you don't, you're subject to sanctions. Now, the Fed, unfortunately, sat in the seat where they could have done the most because there was a statute called the Homeowners Equity Protection Act passed in 1994, which gave the Fed the authority to adopt regulations to prohibit unfair, unfair, deceptive trade practices or mortgage lending practices in the mortgage lending sector. So they could look at a particular pattern or practice like teaser rate subprime lending or liar loan option ARM lending, and they could say that's an unfair, deceptive practice, and we're prohibiting it for all lenders. And unlike most of the statutes, which generally applied only to chartered banks or chartered thrifts, this statute applied to every mortgage lender across the country. So they could have stopped all the non-bank mortgage lenders also. Well, as we now know, a couple of the governors and many of the staff of the Fed and many of the Consumer Advisory Council members of the Fed repeatedly went to the Fed and said, you have to do something. You have to adopt regulations to stop this. And Chairman Greenspan said no. He didn't think it was desirable. He didn't think it was a good idea. He felt that it would cut off credit, which shouldn't be cut off. He wasn't convinced that there was real predatory activity going on. He wasn't convinced the Fed really could figure out what was predatory and what wasn't. Well, of course, Chairman Greenspan was a committed believer in deregulation. He absolutely believed the markets were much better at risk management and risk control and risk identification than the regulators were. I mean, he basically said, I don't think regulators are effective at all. And during the time that he was chairman, although he greatly focused on economic research, the bank supervisory staff was very much given short shrift and shunned aside. And so, I think Chairman Greenspan bears a lot of responsibility for what happened. He wasn't alone. The leaders of the OCC, the leaders of the OTS were taking the same line. The last thing I will say, though, so there was an atmosphere of deregulation, an atmosphere of, let the market go, and we shouldn't interfere. And there were a lot of people saying, provide more credit to people who've never had this kind of credit before, which was very foolish. But there was one other thing going on, which is the income. Okay, if you look at income in quintiles, what you'll see is from the 1970s through the 1990s to 2005, the upper quintile of incomes went up pretty smartly, okay? And then the upper 10% went up even faster, and then the upper 1% went up really fast. And then you find that the middle quintiles and below, basically, this is on an inflation-adjusted basis, barely budged, okay? So basically, real incomes for the lower quintiles were essentially flat. People were not getting real inflation-adjusted increases in their income. I think most studies would show maybe 5% over 30 years. So basically, their incomes weren't going anywhere. So how do you finance consumption when your incomes aren't going anywhere? You borrow. And so what you find is that the upper level incomes were actually maintaining their debt ratios about the same, going up somewhat. But debt ratios, household debt ratios for the lower income quintiles were rapidly increasing. By 2005, the lowest income quintile had household debt to net worth of 400%. The next quintile had household debt to net worth of 300%. The next one had 250%. I mean, this was a guarantee that these folks were going to go bankrupt, were going to default in massive numbers. And we also know that people finance consumption in many ways by refinancing their home, taking equity out, paying off credit card bills, or spending the money. And so $2 trillion of consumption in the late 90s and early 2000s was financed by equity extraction. And so and Greenspan at one point said that he thought this was a very good thing because it allowed consumption to continue when otherwise the economy was struggling, particularly during the so-called dot-com telecom bust of the early 2000s, that the home equity increasing and people taking money out and spending was helping the economy. So to some extent, I actually believe that Chairman Greenspan knew exactly what was happening, but felt, hey, I don't want to cut this off because this is actually what's fueling consumption by essentially 4/5 of the national population. One last number to leave you with. Private sector debt, 1991, $10 trillion. 2007, 40 trillion. Now, this is off the Fed numbers. If you were sitting in the Fed and you were seeing private sector, this is not government debt, private sector debt quadrupling in 16 years, wouldn't you have been concerned? When I saw those numbers, when I looked at them in 2008, I said, oh my God, this is unbelievable. How could they not have done anything to stop this? Okay, of this $30 trillion increase, okay, you have $13 trillion comes out of the financial institutions. Guess why they got into trouble? They increased their debt by $13 trillion. You have $11 trillion of debt coming out of the household. And then you've got the other 6 coming out of business companies. Okay. Does anyone think that the household sector could accumulate and pay off $11 trillion of new debt, or that financial institutions could take $13 trillion and pay that off? No. It's no wonder what happened. So I think there's this great question, which I'm still trying to answer, which is, why did the regulators, and the Fed was in the best position of any of them, why did they watch all this happen and not intervene? Why did they not take action? Is it a story of political capture by the financial services industry? Is it a story of, because of globalization and other factors, incomes for most people are not rising? Only the top are getting increases, and how are the rest going to finance their consumption? Well, use your house as an ATM. Maybe that's the next best thing you can do. But that was a completely self-defeating exercise. They must have known it would be. This wasn't going to go on forever. So was it just sort of burying one's head like an ostrich and hoping that, well, this will either work itself out, or at least I'll be out of office by the time it all blows up? I don't know. But I think there's some really important questions that remain to be answered. So I'll stop there. And I don't know if we have any time for questions. Yes. Oh, yes, thanks.
Thanks. What do you think in response? What were your? So you were mentioning that Chairman Greenspan knew what was going on. He was cognizant of sort of the place that he was leaving, right, and the interest rates and everything. And so what is your response to sort of what Chairman Bernanke said and his thoughts and his perspective? And he was saying how Chairman Greenspan and Chairman Volcker sort of left him with an easier job, and he didn't think that interest rates caused.
I think Chairman Volcker deserves a lot of credit, because I mean, inflation was truly terrible in the 1980s. I mean, the 1970s, and he did take decisive action to stop, break the back of inflation and bring interest rates down, and certainly that needed to be done. Interestingly, Chairman Volcker was not in favor of a lot of the financial deregulation that occurred after he left. I mean, and he's continued not to be in favor of it. So I think Chairman Greenspan, quite rightly said, I want to keep inflation low. I think that was a good thing. But I also think he felt that I can deregulate, all these restraints on consumer lending. I can deregulate, I can allow all these institutions to conglomerate and get really huge, and I can let the market just go. And he would say, I don't think we can spot an asset bubble when it occurs, but when it breaks, we can come in and intervene and stop it. And that's where I talk about the asymmetric risk curve, that through monetary policy and other things, he was allowing asset bubbles to be created, like the dot-com telecom. When they burst, he immediately cut interest rates almost to zero, encouraged the increase in the housing price. And you can see testimony that he gave in like 2002, 3, and 4, where he says to Congress, look, we cut interest rates way down, that pumped up the housing market. People then extracted equity from their homes to finance consumption. We offset the impact of the dot-com telecom bust. This is a very good thing, he says. So I mean, he's actually saying it publicly in testimony. I think he was taking enormous risks. I mean, maybe he felt that was the only cards he had to play, but I would disagree with that. Yes.
You mentioned that Greenspan thought that by maybe restricting the lending practices that the economy would have suffered, especially.
He never quite said that, although I think that may be what he was thinking. He clearly kept saying, I don't want to cut off the availability of credit.
Have there been any studies that have looked at, well, if they had reduced lending, what the economy would have looked like, you know, in the
yes,
mid-thousands?
I think there's a fellow named John Taylor out at the Hoover Institution at Stanford who, you know, took a crack. He's been a very sharp critic of the monetary policy, and I think he did some counterfactuals on what if they had just followed what Taylor is the author of what's called the Taylor Rule, which is what he thinks monetary policy should be, which is pretty conservative. And he said if they had followed the Taylor Rule between 2001 and 2005, you know, he tried to model what that would be. He said he thought that would have resulted in a much slower expansion. It would have taken longer to get out of the dot-com telecom problems, but he thought it would have been a much sounder expansion that would have gone on longer and survived. I mean, the counterfactuals always are difficult, but his view was that you could have had a more conservative, nuanced monetary policy and a much tighter policy on consumer lending that would have probably resulted in a slower expansion in the 2000s, but then wouldn't have resulted in this enormous crisis that we ended up with. I mean, it's at least, I think there's a plausible argument for that. One time for one question, more or not?
So you made a really convincing argument that the United States became far too leveraged during the period of the 1990s and the early 2000s. Do you think that the structure of the financial system and financial innovation do create a capacity for more leverage, just maybe not to the extent that it got
yeah,
prior
I mean,
to 2000?
certainly not all leverage is necessarily bad, but you have to sort of think, whatever leverage you create, can it actually be paid off, you know, within the reasonable life of the financing? And unfortunately, financial innovations, and we saw this in the 1920s, and it's certainly been true for the last 30 years, financial innovations almost always lead toward more leverage, because if you're the equity holder, either a shareholder or an executive with lots of options or a lot of bonus payments based upon earnings performance, I mean, your inclination, right, is to increase the debt and maximize the value of the equity. And already financial institutions are very leveraged. They're always leveraged at least about 10 to 1. Many of these institutions became leveraged 20 or 30 to 1 effectively during this boom period. And so then, you know, you get the excess of speculation and the bubbles that can't be handled.
Great. I'm grateful for Art's presentation and also for his discipline of ending in 25 minutes. When you ask professors, if you've got this amount of time, they're always prone to keep going and going. But Todd and I both were very, very good about that. As Sarah's getting set up here, one thing I wanted to sort of set the table for is you'll notice that what Todd did on Tuesday really set the table very nicely for what Art is doing and also what Sarah is going to be doing here in a second. And then if you also will note that what Art has just done is really setting the table very nicely for what we're going to see next week with Tony Geiser and talking a little bit more about the Fed's regulatory authority in kind of districts, and also Anna-Marie Lasardi and Howard Beals are going to be focused much more on consumer protection. And so it follows very well from what each one of them have said. So it's really setting things up nicely in a way that I can't take credit for because it just keeps up. And it just worked out very nicely. But I'm really glad the way that this is setting up. So now it's time for Sarah Vinter, who's from the Department of Political Science, who's going to be introducing the Congress to all of this too. It's obviously going to cause all kinds of controversy and discussion. So Sarah,
thank you. We have a great sense, I think, from Art about this sort of tight relationship between the Fed and the banking industry, certainly this period of sort of deregulatory zeal. But what I want to do today is sort of step back from that and say a little bit about the Fed's relationship first with the public, the broader public, and also with Congress. In other words, and of course we know, right, we know that Bernanke cares. I don't know about the Fed generally, but we know that Bernanke cares about its reputation with the public, right, not least because he was here at that lectern. So what we need to know is sort of get a better understanding of the Fed's relationship and its standing within this broader political system. Now, one of you in his very last lecture asked him precisely really about this question, and I think it was Kelly. Was it you? I don't know if you remember what you asked him, but I'll just put the words back in your mouth. You said something like this, right? You've demystified the Fed for me, but millions of Americans are still deeply suspicious about the Fed. And so today, that's what I want us to try to come to terms with, which is why is the public so dissatisfied with the Fed? what's the Fed's incentive to respond to that dissatisfaction? And then how does Congress respond? And what I'm going to argue really is that the Fed has what we might call a democratic dilemma, right? And we know that the Fed is a product of Congress, and as such, it is beholden to Congress and what Congress wants from it. But at the same time, monetary policy requires independence. And what I want us to understand a bit more today is that both Congress and the Fed really struggle with this trade-off between what we might think of as independence on the one hand and the Fed's accountability to the broader political system. So the questions for us first: why is the Fed so unpopular? Should the Fed respond to those criticisms? And then what forces shape Congress's response first to criticism as well as to the performance of the Fed? Our goal here is to really understand what motivates these critics of the Fed. So assuming these links are working, so first, right, it's the Ben Bernanke punching bag, right? The caption, when the market is down, right, we find that Ben Bernanke punching bag very cathartic. I really couldn't show this if he was in the room, too, so it's just as well. But what's the sentiment here, right? What's the nature of the criticisms? It's ruining the economy, Dan.
Investors will blame the Fed if stocks are declining. So.
Okay, so right, we're holding the Fed accountable for performance, right? Not for fairness or anything like that, but simply how's the functioning of the economy. This is a polling question from July 2009, and it sort of shows, right, the general public dissatisfaction with the Fed. So they asked people's opinions about the performance of various different agencies. Excellent and good here. Federal Reserve, of course, is down here at 30%. The IRS is even better, right? It's not crazy. 40%. CDC, 61%, right? All they do is tell you to wash your hands, so that's a little expected. And it's not just 2009. What we can see here, and what I've done is to pull every single polling question asked about the Fed from, I haven't back to the sort of 70s, but here from late 90s to last year, and the blue dots are whenever there's a question asked. A couple things here. First, and that's the sort of trend line over time, there is this diminishing confidence in the Fed that kicks in at the time of the Great Recession here. Other thing to keep in mind here is that the blue dots are clustered. So we actually go long periods of time where the media doesn't actually, and polling firms don't actually ask people's views about the Fed, which we'll come to, and why that might be consequential. If you ask people, oh, what did you think about government policies, and granted that covers not just the Fed but TARP as well, right? Overwhelming reason here is who benefited: large banks, financial institutions, large corporations, poor people, middle class get squeezed out or screwed by those government policies. And this is asked in 2010. Okay, so underlying all these criticisms, right, from congressional criticism, we have this idea of an unaccountable Fed, probably overstepping the bounds of its authority or perceived authority. Public criticism that the Fed is just frankly unfair, that it bails out Wall Street at the expense of Main Street and the middle class. And of course, there's a John Stewart critique, right? You just can't trust what the Fed is saying. And that strikes me as part of what's lying behind the Fed's democratic dilemma here. We know macroeconomic decisions lie at the heart, right, of most important choices that we make in a political system. That type of economic stability depends on the Fed's independence, right? Markets have to trust, as the saying goes, that the Fed's going to pull away the punch bowl, right, when the party warms up, that they're actually going to tighten interest rates at the pertinent time. And thus the Fed typically justifies limited transparency as necessary for insulating it from politics. Of course, that's our dilemma here. The Fed was created by Congress. Its powers and autonomy can be curtailed by Congress, and thus the Fed has to figure out how it's going to balance its independence against Congress's desire for accountability. Now, that gets us really to the second question, right? Should the Fed respond to such criticism? And if so, why and how should it respond? One point of view, and this is Bernanke talking during an ABC News interview with Diane Sawyer, I think the day, one of the last lectures he was here. And his argument, to some extent, is that he can't be worried about politics because, as he said, the main thing is that politics is politics, and the Fed is a nonpartisan. Our job is to do the right thing, irrespective of politics. We're not paying any attention to election calendars, political debates. We're looking. That doesn't really sound like Bernanke, but we're looking at the economy. We want to make the right decision. We want to do what's without political pressure, and that's what we're going to do, right? So on the one hand, he's saying that we're actually divorced from much of these political pressures. But as we know, as I've said, look, the Fed is a creature of Congress. As Volcker probably put it best, the Congress created us, and the Congress can uncreate us. That's a guy who spent too much time speaking Fed speak, right? Uncreate? Okay. But the general sense there is that Congress gives a mandate, and that the Fed and thus has to be beholden to it. In this case, of course, we know the Fed is actually given a dual mandate from Congress, that both inflation and jobs matter. And of course, you can't get any closer to the heart of what matters in American politics than inflation and jobs, right? And thus, for all the Fed's desire to say that it's not a political institution, inevitably it's consequential for politics. Now, the Fed also, I think, has motivations to respond to public and congressional criticism. First, there's a political motivation for the Fed, right? The more effective and the more legitimate, right, those questions about legitimacy and fairness, the more effective and legitimate the Fed is perceived to be, the more likely politicians will maintain or increase the Fed's power and independence. All right, so there's a political incentive to just be responsive enough so that they are freed up to pursue their policy agendas. Of course, there's also an economic motivation, as Bernanke has said many times, including in class, right, that transparency makes monetary policy work better, right, and which is behind sort of his economic or macroeconomic motivation for bringing more transparency to what the Fed is doing. The question then is, if we think the Fed does have a reason or motives to be responsive, the question is, how does the Fed respond to the varieties of criticism? And here, if you look across political science literature, there's very, very little that's been written about Congress and the Fed. There was a little bit in the 1970s and 80s when, right after the dual mandate was created. But by and large, we've kind of ignored the Fed. And one of the reasons why is the Fed, as I said, doesn't leave a lot of footprints. Right? We only have transcripts, verbatim transcripts, since the mid-1990s. We have a 5-year lag before we can get into the transcripts. We have minutes come out 3 weeks after the FOMC meetings, but they tend to be a bit opaque. And so there's some limits to what we can take from these footprints that the Fed leaves. Of course, this is the classic Greenspan cartoon here, where Greenspan, he's testifying before Congress, and of course, what comes out of his mouth? I don't know if you can read the caption there, right? It's Jabberwocky, right? It's the world's greatest nonsense poem ever written. 'Twas brillig and the slightly toves doth gyre and gimble and the wave and all mimsy were the borogroves and the main wraith, and it keeps on going, and then he ends with 50 basis points, right? Right? It's sort of the epitome of Fed speak. The rest of it's as if it were nonsense, okay? And yet then he sneaks in the point that everybody is looking for. Now, of course, the Fed doesn't have to speak Jabberwocky to be opaque. And if you sort of bury yourself into going to the transcripts to try to understand, right, we're trying to understand how the Fed responds to external criticism or potential criticism from Congress. This is an excerpt from the 2006 transcript. Geithner, head of the New York Fed, says, "Mr. Chairman, may I ask a clarifying question? Will someone remind us how the minutes are going to characterize the conversation we will have over the next several meetings?" And in the end of 2006, they're discussing, should we adopt an inflation target, right? Which, of course, they don't do until a couple months ago. He goes on, is it going to be a standard section like the one we used last time, which was pretty much without content? Laughter for the rest of the FOMC. And he gets a response from Vince Reinhart, the head of the monetary division there. Well, he says, since you're not likely to be making any decisions, then there's not much to convey in the minutes other than you had a full and frank exchange of views. Laughter regarding your attitudes regarding articulating a price objective. That's the inflation target. Okay, so even when the Fed is transparent, right, we eventually get the transcripts. We know and we have immediate minutes. It's very hard to tell precisely what is going on within the Fed. Okay. Of course, as I said, what we want to get out of these transcripts potentially is the feelings of congressional constraint. Right? Do they care what Congress is potentially going to do to what the Fed is going to decide? And this is a little bit of evidence. These are also from end of 2006 transcripts. This is Fisher from the Dallas Fed. We do, I won't read this all, but we do have a dual mandate. I agree with those who have said that we do not want to run the risk of changing our current charge from the Congress. Right? We don't want them to change the dual mandate. As I listened to Mishkin, I found his arguments remarkably brilliant. I was thinking, blah, 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 it goes on, and then he says, we have to be careful of the risk that either you then have them say, members of Congress say, that's fine, but tell me what your employment target is because you have a dual mandate. or you end up negotiating an inflation target higher than you want it to be. Right? So here we have explicit recognition that the Fed has to tread carefully with introducing an inflation target because Democrats are going to want an employment target at the same time. Now, having said that, right, as political scientists, we like to think we're scientists, right? We want to be a little systematic. And just pulling out these anecdotes doesn't really help us know, right, how often and with what degree of concern does the Fed think about Congress. So that's a bit of a limitation here. And if you go through the transcripts that are available, there's relatively few times at which the Fed actually, there's discussion and mentioning of Congress. Right? But of course, right, the absence of evidence is not, as I say, the evidence of absence. So just because the members don't talk, the FOMC members don't talk about Congress, doesn't mean that there's some recognition of the constraints that they feel as a creature of Congress. So generally speaking, if we had to step back then and think about how does the Fed respond to criticism, clearly the Bernanke Fed's become more transparent, right? Congressional testimony, speeches across the FOMC, press conferences after the two-day FOMC meetings, interviews we know now on 60 Minutes, GW lectures, right? That's all part of his effort to try to deal with the Fed's reputation, particularly the public reputation. Now, having said that, the Fed has also, under Bernanke, actually fought very hard against additional transparency. And he drew the line in the middle of the writing of DoddFrank on where he was going to let the Fed to be transparent and to fight pretty hard against congressional efforts to pull back the curtain quite substantially. So Ron Paul had to audit the Fed move. One of the elements of that was to force disclosure of who borrowed from these emergency lending facilities that were set up starting in September or before September 2008. He fought that one tooth and nail, right? He said if you disclose identities of weakened institutions, nobody's going to want to borrow anymore from these special facilities. He lost on that battle, and so DoddFrank required disclosure, and when those were disclosed at the end of 2010, right, it was a who's who of American finance and international financing companies, right? JP Morgan, UBS Switzerland, Caterpillar, McDonald's, right? Everybody who was anybody in 2008 came to those emergency lending facilities. He also fought, there's a Bloomberg suit to open up the borrowers from the discount window. They fought that one, they fought it all the way to the Supreme Court. They lost that fight. And the Supreme Court essentially forced the Fed to reveal the borrowers in the discount window. Now, of course, there are reasons why a central bank might want to keep borrowers in the discount window secret, but it certainly wasn't the case that that was able to get the courts to agree with them. Well, the question then is, if we have a sense of the motives of the Fed for responding, we have only a sort of rough or opaque sense of how the Fed does respond. The question is a little easier to understand what forces drive Congress's response to criticism of the Fed, and also Congress's response to the failings that they see within the Fed. So the first thing to keep in mind here is that Congress has very uneven attention to what the Fed is doing. So I've gone back to the mid-1940s, and I'm done through 2008 here, so I don't have the most interesting years here yet. Simply the number of bills introduced that address the powers of the Federal Reserve. So, and as you can see, then I've overlaid here a smoothing of the inflation rate, right? And what's the obvious trend here, right? When does Congress pay attention to the Fed? It jumps out, right? When inflation's high, and otherwise, when things like the great moderation here, right? Really, nobody in Congress is paying attention. And we could overlay it as well with this is smoothing the misery index, so taking account of unemployment. The relationship is a little bit off there, but by and large, right, we have the same trend going on here. The Congress responds to the state of the economy, but otherwise really couldn't care less about the Fed. We can also see unevenness of party attention to the Fed. So here, just for all the bills in that previous slide, what percent were introduced by Democrats, what percent were introduced by Republicans. And clearly, Democratic attention runs right up through periods of unemployment and inflation here until 1977 when they get the dual mandate, and then, funny enough, right, Democratic attention slides off as the economy improves. And then, not surprisingly, right, Republican attention starts to grow back as the Fed becomes more assertive there. Now, another way to look at these bills, or sort of congressional attention to the Fed, is to figure out not just what the parties are of the members introducing bills here, but their ideologies, right? Are these criticisms of the bank coming from the left? Are they coming from the right? Are they sort of centrist criticisms? So what I've done here is to take each of these bills in any Congress, and we have ideological scores of how liberal or conservative the members of Congress are who introduce the bills, and then just average up the ideologies of the people introducing the bills. And again, then not surprisingly, in this period, peaking back right to 1977, it's right. The negative scores here are liberals. It's clearly liberal complaints about and criticism of the Fed. In the recent period, we have conservative criticism of the Fed. And then in that middle period where we didn't, right, 80s and 90s during that great moderation, it looks like it's centrists who are paying attention to the Fed, but in reality that's probably noise because there just aren't that many bills that year. There's a limit to these data as we see them here. And again, our motive is to understand why and when Congress is paying attention and what draws them to act on concerns about the Fed. The limit here is that I haven't actually gone into the content of the bills to figure out, right, or these could be bills that try to restrict the discretion of the Fed, right, try to harm the Fed's powers, reduce the Fed's powers, but they could also be bills to expand the Fed's power, in which case it's not, right, we can't really tell much from simply looking at ideologies or partisanship. So for those of you who want to know what professors do all summer, there are about 750 bills in the data set. And you have to sort of go into Thomas when Thomas Library of Congress is available online back to the 90s, back to the 80s or so. And then they have to go to microfiche to pull up bills. So I thought it would make my job easier. It will just bring a couple bills here. So our goal here is, right, and just to give you a taste here of two things, right? First of all, the political scientists have ignored what's going on in the Fed here. And second, sort of what one needs to do to try to come up with a sense of how Congress responds. So this is a bill from 2009, and I think you have the text in the handouts there, but this is the pertinent part. Directs the Board of Governors of the Federal Reserve to make and maintain the value of the US dollar at a market value of 0.002 of a troy ounce of gold. Right? So what's the intent of the bill here? Is this empowering the Fed, restraining the Fed? What's it doing to the Fed? What's it doing to its powers here? Right, it's sticking on a gold standard, which is really to contract the expertise, track the autonomy or the discretion of the Fed. Number two here requires the federal property manager, in this case, Federal Reserve Board, if you control mortgages or mortgage-backed securities, which we know are plentiful on the balance sheet of the Fed, requires them to basically implement a foreclosure program, some sort of mortgage relief based on the fact that you're holding these MBSs on your balance sheet. So what's that doing to the power of the Fed? Is it limiting the Fed's discretion? Right, it's really expanding the Feds, right? It's giving them a new credit, it's giving them new authority and directing them, right? Find new ways of extending credit based on what you're holding in your balance sheet. So immediately, right, we've got some bills constrain the Fed, some bills are empowering the Fed. Oh, my favorite one, right? This is Ron Paul, right? Federal Reserve Board Abolition Act abolishes, right, the Federal Reserve System. Okay, that's just right. That's clearly not empowering. That's the end of the Fed. Finally, this is one from 1986 from a Democrat, amends the Federal Reserve Act to provide that the term of office of the chair shall expire on the adoption of an appropriate joint resolution, right? Which is Congress, we've heard Fed speak. This is Congress speak for if the House and Senate pass a resolution that removes the Fed chair from the board of the Federal Reserve, right, he shall be out, right? From Tuesday's discussion about how do you remove people from office, this would give congressional authority, right? And clearly, right, this is constraining, right, the power of the Fed to force the chair to be much more accountable to what the House and Senate want, lest he be booted from his position. Okay, so we have over 700 bills, but of course most bills don't become law, right? And so what we still need to figure out is when Congress acts, right, or when it's thinking of acting, what are the forces that come to the fore in shaping how it responds to these types of criticisms and concerns about the Fed? And the first thing to keep in mind is that the Congress has competing electoral interests. So anyone who's taken American politics class or a Congress class know that we all refer to members as single-minded seekers of re-election, right? No matter what they want to do, they have to get re-elected first. And so in many ways, that encourages members to be responsive to constituencies like the Occupy the Fed guy who's ranting about the Fed, or other concerns about the fairness of the Fed. At the same time, though, there's another electoral incentive here, which is to stay as far away as possible from monetary policy, right? Because what does Congress really want to do, right? Think about that Bernanke punching bag, right? They want to blame the Fed when the economy goes sour, and they've done that historically. They've done it for 100 years. Whenever the Fed screws up, the very first people out there are members of Congress beating up the Fed. And so, you don't want to draw the Fed in too close. You don't want to make the Fed too accountable to Congress, because then Congress has its fingerprints on monetary policy, and that's a really bad idea. And so it's not simple enough to say that electoral incentives encourage Congress to be responsive when it sees the Fed doing things it doesn't like to see. At the same time, overlaid on those electoral incentives, which really don't vary by party, we have very different party positions on the nature of what the Fed is doing. And so just a snapshot from today, Republicans favor stripping the Fed of the dual mandate, right? They want to get rid of the employment mandate because I think that's leading to too easy policy, monetary policy for too long, and thus want to limit the Fed's discretion. At the same time, we have Democrats today favor protecting the Fed's discretion because, right, their lives hinge on the dual mandate and forcing the Fed to be responsive and to try to maximize employment. And in fact, if anything, they'd like to centralize power on the board, right? As Art mentioned on Tuesday, right, this dilemma of having privately selected Reserve Bank presidents, not all of whom are hawks, but many of whom are hawks, lead Democrats to want to strip them of their voting rights. Of course, at the same time, the Republicans want to give all 12 bank presidents a vote on the FOMC at each meeting, right? And so the parties are at loggerheads here about changes to the Fed, right? And if the parties are at loggerheads, right, that's a recipe for, obviously, is gridlock, right? That's stalemate. And to some extent, of course, that really advantages the Democrats today, right? Because it freezes the dual mandate, right? That dual mandate's not going anywhere, right? Even with large Republican majorities and a Republican in the White House, you're not going to see the undoing of the dual mandate. Just to make things even more complicated, there are also divisions within the political parties over regulation of the Fed and changes to the Fed. Both parties have Wall Street wings. Right? It's not just Republicans. Right? Who represents New York, New Jersey, Connecticut? Right? They're Democrats. And their funding and their campaign contributions come from the banking industry, insurance industry, particularly Connecticut. Right? And so they tend to be quite protective of the Fed. Not entirely, but much more protective than others. So that Ron Paul audit the Fed movement, when Bernanke started to fight elements of the audit the Fed, he was supported by essentially members of the Financial Services Committee, most of whom are from that Wall Street wing of the Democratic and Republican Party. And of course, keep in mind, just to complicate it more, both parties have they have Main Street wings that in fact are quite protective, like amazingly protective of the reserve banks that are in their districts and their states. So DoddFrank, as we'll see in a moment, one of the provisions was to strip the reserve banks of their regulatory and sup and reg powers over the small and medium-sized banks. Right? Now, if you're in a reserve bank and you take away all their authority over small and medium-sized banks, many of these reserves, not New York, of course, but many of the other reserve banks, right, there's nothing left for them to do, right? Right? They become sort of glorified regional economic think tanks, right? They're not doing much if they're not regulating banks, because they don't have any large-sized banks in many of these outside of New York and, say, Charlotte, North Carolina. Okay, and so not surprisingly, when DoddFrank comes up, and one of the things Chairman Dodd, as head of the banking committee, wanted to do was to create an Uber regulator, right? Strip the districts of their regulatory powers, and who's the first person on the floor to fight it, to go against it? The first one is Kay Bailey Hutchinson from Texas. Why is she on the floor? Dallas, right? She's got the Dallas Reserve Bank. So there's a Republican on the floor fighting Dodd. That's not unusual. Right? Looks like that a lot. And then next comes on the floor is Claire McCaskill. Right? Anyone here from Missouri? Okay, why is McCaskill on the floor? Kansas City, and she's got two. Of course she's on the floor. Okay, so she comes on the floor. Minneapolis, I think Al Franken comes down, which is always entertaining in itself. Al Franken comes to the floor. And suddenly there's a large bipartisan supermajority for fighting what the chairman of the banking committee wants to do, and they defeat that one pretty easily. Yeah.
Why are they so protective of the reserve banks? Because, like, is there evidence that, like, many Americans really care about there's this, like, financial?
Well, that's a great question, and I can actually find what I call that reserve bank effect. Right? I see it in 1917. I see it in 1935. It keeps reappearing over history. And I think partly what's going on here, and this is something I don't think anyone's terribly well shown, but there's an economic benefit to having the Federal Reserve Bank in your district or your state, right? And of course, senators and members don't want to disrupt the status quo anyway.
You've got local control of the discount window, among other things.
Oh, absolutely.
Each of those banks provides discount window loans to local
So they become, absolutely, right? So there's some economic, there's macroeconomic, and there's financial benefits to keeping those reserve banks alive. And there's, of course, just general employment, right? These are really, I don't know employment numbers of these reserve banks, but they're really sort of economic machines in their states or
I don't think many Americans really pay much attention to the reserve banks.
Oh, absolutely not, right? But this is one of these things where senators are willing to go to the floor to fight it publicly. I think I'd say that Dodd was surprised, except that he'd been visited by the reserve bank presidents themselves, right? Again, keep in mind, right? Bernanke said we're nonpartisan and we're not political, but he's lobbying as well, right? Bernanke's lobbying. The bank presidents from more conservative districts are lobbying, right, to keep those regulatory powers. So again, there are differences between the parties. There are competing electoral motivations, and then there are actually divisions and commonalities across these two political parties. Okay. Not surprisingly, then, when Congress does respond to the financial crisis and try to work on this, what turns out to be the DoddFrank regulatory reform bill, to some extent, like these Fed critics come together, and I guess at best I'd say snip the wings, maybe trim the wings, right? They're not really demasculating the Fed here. They mandate new audits. The Fed managed to water some of them down. They curtailed emergency lending authority that I think Bernanke mentioned while he was here. They made it harder to use that, what he called the 13.3 powers. They didn't take them away entirely, but they made him go to the Treasury Department in order to set up new lending powers. As Art and Todd mentioned on Tuesday, right, they've altered just incrementally the selection rules for the reserve bank presidents. There are other proposals on the floor. In other words, let's make the reserve bank presidents Senate confirmable positions. Given gridlock, everybody realized if you did that, there would be no presidents sitting in reserve banks. That wasn't going to really go anywhere. But again, it's an element here of whittling down or really sort of diluting some of these reforms. And of course, as I mentioned, they defeated centralization of bank supervision. At the same time, and this is what's so stunning to me, is Congress actually expanded the Fed's powers, right? In this time when the Fed has really pointedly failed, and as the chairman said when he was here, right, that our own super reg powers, right, we were lax on supervision and regulation, as Art pointed out today as well, in lots of different ways. What did Congress do? Well, they gave the Fed new supervisory powers over large systemically financial institutions and non-bank financial institutions as well. And to some extent, that shouldn't be surprising, given the kind of conflicting motives and conflicting coalitions that come to bear here when reform comes onto the agenda. Now, and of course, keep in mind, it's not clear who else would do the job, right? If you weren't willing to start from scratch and create some new, as Dodd wanted, some uber regulator that would take supervision away from the Fed. And that was certainly Bernanke's argument, right? We have the experience. Don't take away our super reg powers here, right? That's part of how we do good monetary policies, to know what's going on within the banks. Okay. So, and the Fed, not so fast. Congress should be clear now. Congress rarely speaks with a single or a fixed voice about the Fed. They like to pay attention when the economy sours. They prefer to blame rather than reform the Fed. Partisan disagreements complicate reform, and as well, these bipartisan coalitions at times protect the Fed. And something we didn't really have time to get into here, that congressional rules really pose a very steep barrier to reform. Unless you have a large bipartisan supermajority of 60+ votes in the Senate, you're not actually going to have large-scale reform of the Fed, which I think really is why that dual mandates is not being changed anytime soon. For the Fed's future, obviously there's much more to be said than fits on a slide here, but just to give a sense here, I do think it's an uphill battle for the Fed to really improve its reputation, right? Both its reputation in the public as well as with Congress, right? The very best thing that could happen for the Fed, of course, is for the economy to recover, not least because, right, you put away your Ben Bernanke punching bag, right, for starters, and then Congress whittles away, right? They really don't pay much attention at all. But of course, it's a little bit problematic for the Fed because, as we know, it can only directly influence one side of that dual mandate, right? It's very good direct control over interest rates and thus inflation and future inflation, but very hard to directly control the level of employment. And just to wrap up here, I think this increased transparency is a bit of a double-edged sword for the Fed. On the one hand, it may keep Congress at bay because we know more now about what the Fed is doing. But of course, then we also learn, and markets learn, more about internal Fed dissent. Right? Last night, the vice chair of the Fed gave a speech talking about actually we should keep rates near zero past our commitment to 2014, keep them to 2015. Well, earlier in the week, one of the Reserve Bank presidents had given a speech, well, maybe it's time to curtail them much sooner than 2014. Well, that's transparency, and to some extent gives us a sense of the disagreements and the difficulty of forming monetary policy, and perhaps a sense of where they're going. But of course, for markets, right, that's really, it makes it much harder for the Fed to convince markets, right, to trust the Fed, right, and to maintain the Fed's credibility that it will keep rates low, but still be prepared to tighten. So I suspect one day the Fed may yet, right, regret its efforts to pull back the curtain, even though at the time it seems like they really have to. Right? But you know, like once you pull the curtain back and you see how the monetary policy is being made, it makes the Fed's job much harder. And I'll stop there. Questions?
I know that, well, I was reading a paper by Professor Alan Binder of Princeton, and he said that lending to foreign institutions and monetary policy are still not audited. And I had a thought while writing my paper that potentially it could be lag audited in a sense that a few months after, you know, Congress would review the explanations for why they undertook these monetary policy decisions. And I was wondering, what is the Fed's argument against this, and what would be a good defense?
With my limited knowledge of monetary policy, but essentially their argument is that once you disclose the identities of folks going, say, to the discount window, if that window is reserved for institutions having a tough time, right, you don't want to have a run on the bank. Right? You don't want to disclose publicly that this institution is failing or short of failing, and then have investors short it and so forth. And so keeping the identity secret is a sort of an extra effort to bolster the finances of those borrowers. In essence, DoddFrank has that type of compromise that you're pointing to. That I think it's after 2 years they have to release the discount window names. So there's a little bit of compromise that's coming out of it. Yeah.
I'm looking at the graphs. You pointed out the slides with the congressional attentions,
Okay.
the two, with the number of bills from Congress, and it's plotted against inflation rate as well as misery index.
Okay.
And although it appears to have, there appears that there is a time-lagged correlation, that doesn't really, you know, any statement about causation, I think, is speculative. But wouldn't this suggest that Congress is actually influencing the Fed, that the Fed is responding to the number of bills that are coming from Congress, or?
Okay. Well, it's a great question, and as you said, look, I've got a time series here, and I haven't done any analysis, right, to squeeze out, right, what direction the arrow is going. That's one of my guess is going to be quite hard to do, right? The question is, does the Fed actually worry about bill introduction, right? Do they worry about proposals fomenting? So even if we were able to, right, we do run the statistics and try to control for which direction the arrow is going here, is there a plausible story that the Fed is anticipating potential congressional action? I don't know, just because there's a lot of crazy stuff going on in the numbers here, right? As we know now, they range everything from putting the Fed on a gold standard to giving it more discretionary power. But I think your broader point is right. It's not clear which way the arrow's going, right? Is congressional attention driving the Fed, or is what the Fed's doing driving Congress paying attention? But again, that's one of these unanswered questions I think that's worth thinking about.
When I asked that question to Dr. Bernanke in the last lecture about the Main Street versus Wall Street divide, he didn't really give me a clear answer. I was just wondering how you see these tensions playing out in the future. Do you think they'll die down as the economy recovers, or do you think this will always be a problem the Fed faces?
I suspect tension will wane when the economy improves. Now, having said that, most of these, or many of these estimates suggest that it could be a long time before you're back to pre-recession employment and economic and growth. That's a long time, right? That could be right, from all these, basing on his name, Reinhardt and Rogoff, right? There could be a decade of sluggishness, right? Japan example.
It has 2 decades and haven't gotten back, yeah.
Or 2, right? And that suggests that even though with time the Fed's reputation will improve, that's an awful long time to be subject to criticism.
There's one other thing over here, the income distribution. Because if you look at income distribution, Wall Street is way up at top, so they're doing really well. Main Street is, those are the bottom 4 quintiles, and that's starting to resonate on Main Street. What is the future for myself and my kids? Why is the system not working for me? Who's to blame for the system not working for me? That income distribution may have some interesting political impact, I think, although who knows. It's been around for a while, but it seems to have only recently gotten a lot of public attention.
Fair enough.
Time for one more.
Sure.
You spoke a little bit about DoddFrank, and many have claimed that it asserts undue financial regulation on the market, especially on businesses who now know the consequences of risky lending and aren't likely to make the same mistake twice. Do you feel that this is true, this is valid in any sense?
With the caveat that I study Congress rather than industry. My hunch is it's hard to make sense of those arguments before the full force of Dodd-Frank is felt. And granted, people can anticipate how regulations might affect them, but those regulations are still being written. And in part, they're being written with a lot of influences, Art will tell you, from the banking industry. So my hunch is, with experience we have of what happens during deregulation, that it might be a little early before you open up the floodgates again. That's just my sense. Great. Well, thanks.